The UK has faced an extended period of time where it has had low productivity growth. For over 10 years, the UK's productivity growth has been almost flat. The problem that is causing this is potentially short-termism in the boardrooms of British companies. So essentially, British companies, instead of looking towards long-term investment, are instead focusing on meeting short-term targets, such as revenue or profitability of their companies. Company boards should look after the long-term interests of their company. However, when you have pressure to reach targets set for profit each quarter or each part of the year, you're tempted, or there's a temptation, to cut important investments such as research and development, advertising, or invest in new plant equipment in order to make sure that you meet the short-term targets at the cost of meeting long-term targets. The difficulty is, if a board of directors knows that it misses a target for profitability, its share price will decrease significantly, and this will make it easier for the company to be taken over by another company. And if this happens, this is quite likely going to result in the board being removed from their jobs. What this creates is an incentive to focus on the short term at the expense of the long-term welfare of the company. After all, who's going to worry about what's going to happen in 10 years' time if you don't know whether you'll still have your job next year? So what's the solution? In some countries, boards are allowed to block takeovers they don't approve of. If this happens, they can invest for the long term, but they don't have to worry that in the short term, someone might take over their company and they might all lose their jobs. But there is a trade-off. If boards are allowed to block companies from taking over their company in order to ensure they can focus on the long term, they can equally do so to protect them and allow them to live the quiet life, underinvesting and not competing, because they know that whatever happens, shareholders are going to find it difficult to have them removed. So policymakers face a difficult decision. Whichever way they choose to regulate takeovers, there is a potential inefficiency that will creep into the economy. The law should be changed to allow takeover defences, but only for a specific purpose and for a limited period of time. So for example, a board could put to the shareholders the idea that they will be protected from takeovers for a period of 4 years while they invest in new plant equipment, which reduces their production costs by, say, 5%. As an extra line of defence, these proposals would be put forward to an investment bank which is selected by shareholders, and that investment bank would check to make sure that the figures are reasonable and realistic. If this reform is implemented, this will allow companies to invest in the long term, safe and secure in the knowledge that it will not lead to a takeover and removal from them being on the board. Meanwhile, if the company board seeks to live the quiet life or doesn't deliver on its promises, then eventually the protection period will expire, and at that point shareholders will once again be free to accept takeover offers. What we have then is board accountability with long-term productivity. In short, if this reform is implemented, it is essentially a win-win situation. Now, I appreciate this is a very short summary of the research, but if you are interested in contacting me, please talk to me and I'll be happy to explain it in more detail.